Yep, I'm ready when you guys are. Oh,
Hello, this is Pinnacle Cycles, and this is our business plan presentation. Kevin, Naima, Julie, Kat, and Giselle. Executive summary. So, we are Pinnacle Cycles, and our focus is delivering fast, reliable bikes built for performance, adventure, and value across the speed, mountain, and recreation segments. In our first 3 quarters, we launched 5 bike models, opened 2 stores, captured the highest market share, which was quarter 2 at 51%, quarter 3 at 34. And among all competitors, we are ranked number 1 in total performance, financial, market, wealth, and assessment management. We had no lost sales, no ill will penalties, and met demand in every segment. Our business is debt free, financially strong, and generating excellent returns. Looking ahead, we plan to redesign or launch a 6 bike, open a third, fourth store, boost investment in R&D, brand reputation, and employee productivity to improve morale and build long-term strength. Financial market performance. Pinnacle maintained a debt-free position through the first 3 quarters, allowing flexibility for growth. Financial risks. Financial risk. We consistently achieve strong cash flow and profitability, reinvesting earnings into product and development and expansion. Across quarters 1, 2, 3, we had no lost sales, no ill penalties, reflecting accurate forecasting and efficient operations. Our brand-led and key simulation metrics, including total performance, financial performance, market share, and assessment management. Store expansion and product launches were timed effectively, supporting steady sales growth across all 3 segments. So for the customer assessment and the current market situation for our speed, what was working was our bike S30 has sold 383 units in quarter 3, which was our top performer, which was priced at $1,559 with no rebate, and it's our strongest one so far, and which is our number 1. And what needed improvement was our bike S26, which only sold 68 units, which is showing a weak demand, which is priced at $1,580 with a $50 rebate. This value proposition may be unclear or too similar to the S30 Limited is appealed despite the discount. And then for a mountain segment, what was working for that one was the bike M30. That one sold 256 units in quarter 3, showing a strong performance in the mount category, priced at $1,300 and $1,330, and with no rebate. It offers great value and meets customer expectations. It is our number 2 internal priority and continues to grow traction. Our feedback for that one was positive, especially for the trail durability and off-road performance. What needed improvement was its awareness and visibility for the M30. It can be improved to boost demand. As competition increases, a stronger marketing push may be needed to stay competitive. And this one was for our recreation segment. What was working for this one? The R30 bike was our top seller in quarter 3 with 433 units sold, offering strong features at $99 with a $50 rebate. The R25 bike followed with 311 units sold at $888. And that was appealing to value conscious buyers. Both bikes received perfect price judgment scores, showing our pricing strategy is working. The R30 and R25 hold our number 3 and number 4 priorities, respectively. What needs improvement is this segment is highly price sensitive, so we may need to boost brand messaging and customer experience. Clear differentiation between the R25 and R30 could help guide buyers' decisions. The competition, so this is for the market, for the competition. So we are competing against the Good Bike, the Thunder Bike, Bite, and Back to Bike. These brands often rely on deep discounts or low pricing to attract buyers. The Good Bike uses premium designs but depends on large rebates. The Thunder Bike pushes low price models in the speed and recreation segments. Bike focuses on affordability and functional bikes, especially in mountain and recreation. The Back to Bike is aggressive across all segments, combining solid features with competitive pricing. Despite this, Pinnacle leads in market share and performance. Our bikes consistently match or exceed competitors in demand and customer satisfaction without relying on rebates. In quarter three, we met demand in every segment with no lost sales or penalties, providing our strength in forecasting and product quality and brand positioning. So this was our company's strengths and weaknesses. So our strengths were a strong balanced product line that performs well across three segments. The S30 and R30 are our top sellers. We currently lead the market and share financial and customer satisfaction, debt-free, strong cash flow, and room to invest and grow. Our weaknesses were the S26 is underperformed, even with the rebate. The M30, it needs visibility and boost demand, and our competitors are relying on low prices and deep discounts. Major problems and opportunities. Boost brand awareness, marketing, and mountain recreation. Increase the M30 visibility. Use strong cash position to invest in R&D new models. Consider expanding to new cities and markets to grow sales. Leverage success of the S30 and R30. The problems with the S26 was underperforming. Competitors' discount could hurt our value perception. The recreation segment remains highly competitive, and the speed segments expectations are rising, requiring innovation and staying ahead.
One marketing strategy is investing in new features for bikes. This can increase brand ratings by having high quality materials. Market differentiation can meet customers' specific needs and reduce competition. The second marketing strategy is advertising more in magazines and search engine marketing to reach customers for each segment. Also, revising each quarter by looking at competitor ads to rearrange ranking of benefits and increase ad ratings. Another marketing strategy is maximizing market share by offering competitive prices for customers who want low cost for the bikes. And the marketing tactical plan in quarter one, I designed two mountain bikes and one speed bike based on the customer wants and needs. The mountain bikes have the same features, except the brakes and seats are different to see which one customers like more. In quarter two, I kept the same designs for the mountain speed bikes. The maximum amount customers are willing to pay for a speed bike is $1,580. So I decided to price the bike at $1,500, and the maximum amount customers are willing to pay for a mountain bike is $1,365. And I decided to price that one at $1,300 and the other one at $1,289. I set up search engine marketing. I created one ad for each segment. The total number of inserts is 13 for the magazines. I bought market research to analyze data for brand design, pricing, advertising, and see competitors' data. In quarter three, I modified features for a speed and mountain bike based on data. Also, I designed a new speed bike. I designed two recreation bikes since we decided to add the recreation segment. I decided to increase the price for mountain speed bikes for this quarter since the brand rating is 100 for quarter two and wanted to see if customers would pay more. I revised 2 ads and designed 3 more ads to increase ad ratings and reach more customers. I managed web pages by selecting segments and keywords, and I bought market research again. In Q4, I decided to invest in mountain super traction tires to create an upgraded mountain bike in Q5. I chose to invest in racing sleek, very fast tires and carbon fiber aerodynamic drop handlebars to create faster speed bikes for Q5. And then in Q5, I plan to invest in a performance bike computer since customers for the speed segments you have a high need for a navigation assistance. I plan on adding a full suspension to the mountain bike to soften the rough terrain. I'm going to invest in a carbon fiber riser handlebars and hybrid comfort tires to upgrade the recreational bikes for Q6, and then invest in a carbon fiber material that's stronger to add to each bike segment for Q6. And then in Q6, I plan on investing in a bright, colorful frame to make the bikes more appealing, high intensity LED lights to increase visibility, and a large mesh tote basket for the recreational bike. In Q4, I decided to decrease my prices because in the previous quarter, the price ratings were a little below 100. And for the other quarters, I'm going to decrease cost of the bike to stay ahead of competitors.
All right, for the sales strategy, in Q1 and Q2, we opened the New York store and the Bangalore store. So then by Q3, we sold 1,452 units across 5 brands with 1.75 million in revenue and 1.16 million in gross margin. No stockouts, so we had strong inventory management. Upcoming market expansion, where the Amsterdam store is opening in Q5. So we've already pre-hired 5 trained sales reps across key segments to ensure immediate readiness. So we're going from 10 employees to 15. We're focusing on our customer fit. So we have more sales reps in the speed segment as well as the mountain segment, but speed is our top performing currently. Looking forward, there's no new stores planned beyond the Amsterdam opening in Q5. So I'm going to be monitoring demand per rep to fine-tune the staffing and territory assignments for bikes. Next slide. And then in terms of our HR strategy, we're doing strategic hiring. So we increased our headcount from 10 to 15 sales and service employees. Again, hired and trained 5 new reps for the Q5 Amsterdam launch. Our hiring expenses are 3,524, and then the total salary and training costs this quarter were $88,649. I did make some adjustments to the compensation for next quarter, as there was some satisfaction problems. So I raised it modestly for the production workers and the heads of the production workers. And then for next steps, I'm going to monitor the return on investment on the salary increases and then adjust the compensation and hiring to match the evolving demand and coverage.
So for the manufacturing strategy, the previous 3 quarters, our strategy focused on gradual fixed capacity buildup. So increasing the 3D printers each quarter so that we can continue to increase our operating capacity and we can align the capacity with the demand while also balancing our investment. For the next 3 quarters, we will continue to expand fixed capacity by increasing the number of production units, doing this by purchasing more 3D printers to ensure that the total available capacity aligns with the forecasted demand. And we are going to optimize operating levels, so adjust daily production operations to ensure sufficient and effective output. After accounting for the workforce productivity and productivity management, the next 3 quarters, we're going to prioritize improving and maintaining a stable level of worker productivity through training and performance monitoring. We will also need to control the overtime use and limit our use of overtime so that we can prevent cost inflation and productivity loss. So only using overtime to cover small gaps in between demand and available capacity. And we will also minimize operating changes that will trigger any additional overhead expenses and just focus on efficiency gains within the current systems before scaling any further. Next slide, please. And so for Q1, we focused on foundation and planning. We did an initial investment of 3 printers to establish our initial fixed capacity of 24 units a day. And we had a $720,000 capital outlay, and we focused on operational setup and workforce training. And so our Q1 was just kind of a foundation, beginning phase to inform Q2 what our capacity will be and operating decisions would be. And in Q2 is when we had our fixed capacity expanded to 24 units a day. We already had 3 printers, and we had a future increase already planned with adding an additional printer to increase our fixed capacity for the next quarter. And we operated at 21 units a day with an 80% productivity, which exceeded the demand, and we ended up building inventory. We set overtime in Q2, so we set that to overtime to build a buffer. And for Q3, we ended up having to expand our fixed capacity to meet the demand. And we had our operating capacity set to 28 units a day, but productivity did drop a little bit to 72%. And the total cost did increase due to lower efficiency and recurring capacity and adjustment expenses. But moving forward in the next quarters, we will limit the use of overtime and continue to increase operating capacity.
As for the financial strategy, this is what we have been doing. We are doing our best to maintain a positive operating cash flow, which includes optimizing production and marketing ROI. This will continue to refine the cost structure while also increasing our revenue. Next, we are aiming to lean into a more financially conservative territory. What this means is that we are avoiding debt currently. We are doing our best to maintain a state of liquidity and also investing for the long-term future. So as for our pro forma cash flow, as you can see here in Q1, we actually had a negative $2,090 net operating cash flow, and this was due to our initial high upfront expenses. These expenses included the research and development cost, as well as store expenses. By Q2, fortunately, our net operating cash flow had increased. And what caused this was our strong revenue inflow, as well as our controlled production and marketing spending. Next, Q3, we were able to remain positive in terms of our net operating cash flow, which is good. As for our cash flow sheet, We have a heavy reliance on equity financing. We were able to raise $1.5 million in quarter one and then 500K in both quarter 2 and 3. We are doing our best to maintain a conservative cash management flow, which is why we only deposited 100K into our 3-month CDs in quarter 2 and 3. Then our cash balance increased steadily each quarter. As you can see, quarter 1, quarter 2, and quarter 3 have all steadily increased. And this indicates a healthy cash runway, which is due to our well-managed financing relative to our operating and investing needs, significant investment in the fixed production capacity in all 3 quarters, which these investments support future scalability, even though it temporarily reduces our available cash. As for our balance sheet, we had an increase in current assets. Our current assets are the cash flow and the 3-month CDs, which were introduced in quarter 2. As for our total assets, these increased each quarter. This shows a healthy expansion in the company's resources. We are proud to announce that we have 0 debt currently, which suggests self-funded growth through equity, and we are 100% equity financed. As for the financial health insights, growth in retained earnings indicates profitability. Long-term growth strategy is present since there is investment in fixed assets. Equity-based financing gives Pinnacle Cycles more control while avoiding interest expenses. As for our income statement, we had an increase in gross profit and gross profit margin. We found in quarter 2 that we had around a 65% increase in the gross profit margin, and then in quarter 3 we had around a 66% increase. This shows that the cost of production goods is well managed, which gives room for Pinnacle Cycles to continue to grow. However, as for our operating profit, we of course saw the loss in quarter 1, which was to be expected, but then we are now seeing gain in quarter 2 and quarter 3, which shows that we have an improved market efficiency as well as a market strategy. As for our income statement, which continues here, we have a net income that has been low in quarter 1 in the negatives, and then a gain in the quarter 2, but however, we have seen a loss in quarter 3 again. This could be due to the higher revenue, which has resulted from no tax loss carried, which was used up in quarter 2 possibly, as well as higher operating expenses. As for our earnings per share, can you go back? As for our earnings per share, we have a negative 19 in quarter 1, and then a positive 16 in quarter 2, which was our big gain. And now we are seeing a loss in quarter 3. The decline of the earnings per share in quarter 3 suggests that there are possible share dilution, i.e. more shares issued, and lower net income due to taxes and rising costs.
So this is our tactical plan overview from quarters 1 to 6. Quarters 1 to 3, foundation and market entry, we focused on building a strong lineup with the launch of 5 bikes, the S30, S26, the M30, R25, and R30. We gained early market insights and built brand recognition across all 3 segments, kept marketing targeted and cost efficient, avoiding heavy rebate use, maintain efficient operations, avoided lost sales, and maintain debt free while expanding to 2 stores. And then Q4, expansion and brand evolution. We're introducing the new models, the S40, M40, and the R40 to meet shifting customer needs and expand coverage. Invested in product development to strengthen segment positioning. Shifted marketing to focus on digital ads, online presence, and segment alignment. Added a third printer, 3D printer, to boost capacity and support continued growth. And in Q5 to Q6, scaling and optimization. Plan to scale top performing models and refine the new product lineup. Monitor demand trends and adjust pricing, promotions, and strategy as needed. Continue investing in HR, training, and customer experience to support loyalty and retention. Stay financially disciplined to preserve our debt-free advantage while funding future growth. And that is it.